Hi, welcome to our commercial seminar today. My name is Jenny Ching. I am your 2021 Education Committee co-chair. Today, our topic is Opportunity Zone Funds. We invited Mike Hardy to our seminar. He actually came a few months ago, because of the well feedback, so we invited him again today. So before we begin, a friendly reminder about today's seminar. All participants will be muted during the meeting. So please use the chat box for questions and the speaker will answer them during the Q&A session. Let me give you a quick intro about our speaker, Mike Hardy. Mike has 20 years of securities, mortgage banking, and the fund management experience with concentration and extensive experience in residential real estate. He's currently a managing partner of California business for Churchill Mortgage, providing leadership and oversight.
How do I get that option up again?
People and managing 500 million. Mike is also a real estate investor and former partner with 55 Capital Group, having fund management experience buying and selling 100 plus properties over the last 10 plus years. Personally, Mike has been married for 24 years with 4 children, ages 13, 15, 17, and 20. And he's living in Laverne, California for the past 20 years. For hobbies, Mike is an Ironman and currently working on his pilot license. So let's welcome our speaker today, Mike Hardy.
Thank you, guys. Appreciate it. It's great to be here, and this will be a fun conversation. I'm going to present on a handful of things that I think are fascinating and even something that The Economist calls one of the world's best kept tax secrets. So we're going to talk about a bunch of stuff today. So first of all, thank you for being here. Just to kind of let you know what we're going to cover, I'm going to walk through a little bit of an agenda and then we'll get into it. So first, I want to cover a little bit of backstory about how and why and what piqued my interest, first of all, in the opportunity zone, and then in establishing a qualified opportunity zone fund. I want to also cover what is an opportunity zone. We're going to cover why it was created. We're going to talk about what problem it solves, what the advantage is to the investor, what the advantage is to a real estate professional, what an opportunity zone fund is, and then also why more people are not maximizing this and taking advantage of this. And so I also have somebody that's going to co-present with me, Suhei Pidra, who's here. She's also a co-host as one of the participants. And she is a very forward-thinking tax professional and is going to help us unpack some of the tax law, and I think even work through a couple of examples a little later in the presentation. So thank you guys for being here. Much appreciated. I am curious, just for some perspective, if I wanted to have you guys just type just the number somewhere from a 1 to a 5 in the chat, with 5 being you've got a really good understanding and 1 being a very limited understanding of the opportunity zone and all that it entails. If you could just type a 1 to a 5 in the chat so I can have a pulse on kind of where the group is for some perspective. Okay. All right, looks like a lot of 1s, 2s, 3s, 1s. Okay, got it, some 3s. All right, and yeah, okay, I didn't see any 4s or 5s, so that's great, perfect. Okay, and this presentation is really going to be geared to a 1 to a 3 range, so that's great. That makes a lot of sense. And Suhei, you and I can go back and forth as needed as things come up. So And then one other question, I'm just curious if you could, so I know where people are from, if you could type in the chat the city that you live in. What is your home city? That would give me some perspective as well, because we're going to look at some opportunity zones as well. Okay, Temple City, Alhambra, Encino, Temples, Arcadia. Okay, great. Okay, Rosemead, Palos Verdes, Monterey Park. Okay, good. Thanks, guys. That's super helpful. So, San Gabriel, Diamond Bar. Okay, got it. All right, I know where the concentration of the group is going to be. And then I'm also curious, one more thing. I know this is primarily commercial oriented, but I'm wondering if, last thing I want to know in the chat, just for perspective for me, is if you are primarily commercial or primarily residential. I do know a few that are residential that are going to be on here. Just type in if you're primarily commercial or primarily residential. Residential. Okay, gotcha. So it looks like a good mix. Got it. Okay, both. Okay, great. Okay, fantastic. Well, thanks, guys. So that helps me a bit for perspective to get started, and I will make a little bit of just adjustments based on the feedback here. All right, so to cover, this has been called the world's best tax strategy that you've never heard of. Okay, and I talk to a lot of very sophisticated people, investors and real estate professionals, and each time I get into what's possible with the opportunity zone, I get looked at kind of with a little bit of a sideways look that sounds too good to be true. Okay, so I'm going to walk through, first of all, the backstory about how I got involved in this. I want you guys to have some perspective on me and why I'm doing this and what I see here that could be an advantage and that is very much not maximized from my opinion. Okay, and we're going to speak to the advantage of an investor, and we're going to speak to the advantage of a real estate professional. So first of all, as mentioned, I'm an investor myself, and I have fund management experience in the background and a partner in a mortgage company. And one of the things that I'm always looking for is what is something unique that I can bring to the table that will separate me from the competition. And what I noticed just over the last couple of years is the opportunity zone is clearly one of those areas. So here's how this started. My background prior to lending was working as a financial advisor, and I did that for a number of years. And so I was serving as the chair for Azusa Pacific University's Financial Advisor Network. And what we would do is we would do presentations to real estate CPAs and financial advisors on just unique, different techniques in the marketplace. And so we were doing a joint seminar that was on a 1031 exchange, and I know you guys have had Phil Atwan present to your group before. Phil's a longtime friend of mine. So Phil was the presenter for 1031 exchanges. We were also doing something on the 721 provision, which is the security side of 1031 exchanges. We were talking about charitable remainder trusts, and so we had an attorney speaking on charitable remainder trusts, a little bit on a Delaware statute or DSTs, and then finally on the opportunity zone. And I couldn't find anyone that really had good expertise and experience that could speak to real estate professionals and investors on the opportunity zone. So I thought, okay, you know what? I will do this presentation, not as an expert, this is a couple of years ago, but as an investor, and I had a series of investments I was doing at the time. And so I saturated myself in the OZ opportunity and tax law for about 3 or 4 weeks to get up to speed. And I realized, my goodness, this is the world's best kept secret. So that's kind of how this started. So then fast forward, took about 6 months of doing research and ended up with a partner of mine that has significant fund management experience. We launched the Cyrus OZ Fund, Opportunity Zone Fund, a little over a year ago. And so my introduction to this was simply because I couldn't find folks that were trustworthy and competent and really in the weeds on the opportunity zone. And I knew that from my own personal experience, it was a pain point. So my next question for the group, have you ever personally had a 1031 exchange that has busted? Okay, I have. I've had a 1031 exchange that's busted. And I know that oftentimes one of the things that's a challenge for an investor is I just don't want to pay that tax. And I cannot always find a good option for a 1031 exchange. And so in doing this presentation, this research, I realized that the opportunity zone and the fund was an ideal fallback, or potentially even in some cases better opportunity based on what's available. So that's a little bit about the backstory. Okay, so now I'm going to give some 30,000 foot context now, first of all, about just how I think, and then we're going to get into the weeds and into the details. So I have a mentor of mine by the name of Mike Frank that said something really fascinating to me a number of years ago. He said, if you want to earn a living, be custom or customized. But if you want to build wealth, or truly build a business and build wealth, create a system and create systems for everything. Okay. And so part of what I'm going to talk about will be how to systematize this. That's number one. And then number two, I recently read a book by the author James Clear called Atomic Habits. And James Clear said something which was really profound. And it was, we do not rise to the level of our goals, we fall to the level of our systems. We do not rise to the level of our goals, we fall to the level of our systems. And I'm very systematic, always have been all my life. And so one of the exercises that I go through just on a weekly basis is something called the General's Tent. And I want to talk about that for a minute or two, and then we'll get into the OZ specifics. And this actually comes from The Art of War from Sun Tzu, which is, there's a saying in there, which is the battle is won in the general's tent long before the battle is joined. And then next part of that is strategy without tactics is the slow course to victory. Tactics without strategy is the noise before defeat. And I thought about that, and it was, I'll say it one more time. Strategy without tactics is the slow course to victory. Tactics without strategy is the noise before defeat. Okay, and I think there's so much tactical action without a sound strategy that exists in building wealth for investors and for real estate professionals, that I saw this opportunity zone as a way to fit into a bigger system that I knew would help me personally. And as I was realizing that there is just not a lot of really good options if you don't have a good 1031 opportunity, that this could be a really good part of the system to be able to help in terms of efficiency and maximizing wealth building. Okay, so I say that so part of the General's Tent exercise that I go through once a week, it's usually on Sundays, is I ask myself a series of questions, both personal and professional, to unpack and make sure that I'm gleaning the lessons of the past, and then I'm going to maximize the opportunities for the next week. And so one of those is then I'm going to list out what are my key 4 objectives, both personally, in business, and then for investments. And so as I do that each week, what kept coming up as I'm thinking about that is moving further and further into the opportunity zone. It's almost like, it's sort of like the car driving at night. You can only see about 200 feet ahead, and you drive forward, and then, you can see where to go. And so that happened to me for quite a while in just getting up and running with the opportunity zone. So over the years, I've noticed that there's very different disciplines when it comes to wealth and money. And one of them is making money. The other one is keeping money. And then the third one is growing money. Okay, making money, keeping money, and growing money are very different mindsets and different disciplines. And I bring that up because one of the things that the opportunity zone allows, it checks 2 boxes for me. It certainly checks the keeping money because the tax advantages are significant. We'll get into that in a moment. And the compounding benefit of having not having to come up front with capital gains tax if there isn't a 1031 exchange available is very significant if you look at the compounding over time, and we'll get into that in a little bit. And then second, on the growing money side, so this checked the keeping money and the growing money box for me. Okay, so that's next is there's 4 different mindsets, and I want to share this And then I'm going to jump into do a screen share and get into some of the specifics, but this will really set the stage for, I want you guys to understand how I think and how this was birthed and how this came across. And so there's 4 different mindsets that I'm always very in tune with and cognizant of, which is the hustler mindset, the entrepreneur mindset, the CEO mindset, and then the emperor mindset. Okay, very different. And I'm saying this for a reason. It's going to relate to the conversation. The hustler mindset thinks in terms of, what do I need to do today and how do I have a good month? The entrepreneur mindset thinks through, how am I going to set up some systems to be able to have a business that works and, a good month into year. It's really sort of a next level mindset. The CEO mindset is really thinking over the years and over the course of a decade, the trends that are taking place and what's happening how do I get in front of the trends, and how do I have the combination of people, profit, production, and protection in place for my business that's going to bring longevity. And then the emperor mindset is the individual, or the mindset that is thinking over decades and generationally and into legacy planning, generational planning. Okay, so all of these tie back, as we all know, there's, the climate is always shifting politically and economically. And so navigating that is not simple. And it takes, quite frankly, sometimes we have to jump back and forth between the hustler versus the CEO, because things change and we need to hustle to move something from one point to another. Okay, so those are the 4 different mindsets. So now we've got the stage set. We have the general's tent with the investment side. We've got the different disciplines of making, keeping, and growing money. We have the 4 different mindsets of hustler, entrepreneur, CEO thinking, and then emperor thinking, which is decades and generation legacy. Okay, so, and all this ties into having and creating the capacity to build wealth. Okay, so I say that. Now, let's get into some of the specifics. Okay, the first question is, what is an opportunity zone? Okay, how did this come about? What is an opportunity zone? And actually, I'm going to see in a minute, I'm going to do a screen share. So let me just make sure I can do that. Well, let's see. Guys, since we didn't have the time to go through the questions on there, the screen share is, oh, there it is. Okay, I've got it. All right, so I'll do that in a minute. Okay, so how did this come about? What is the opportunity zone? This was birthed from the 2017 Tax Act that took place. And it's interesting because the goal of the opportunity zone was really to do 2 things. I mean, the biggest one was to pull investment funds into areas that were not as affluent, to be able to create capital to then bring areas to life. Okay, and so the opportunity zone in and of itself, which is designed and chosen typically by the state will choose the lower income areas as opportunity zones. And once they've been designated as an opportunity zone, it allows for investors then to have some pretty significant advantages by investing in qualified opportunity zone funds. So, all right, let me do a screen share. All right, so guys, let me get back into the conversation then. The goal of the 2017 Tax Act was to attract investment into lower income areas. And, oops, I seem to be frozen.
We could still hear you, Mike.
You can? Okay, got it. I have everything not responding on my computer, so my apologies. All right, so you can still hear me. So the goal of this, guys, or the 2017 Tax Act was set up specifically to be able to attract investment. And it was created to be both a win for underserved areas and to be a win for investors.
So the website that Mike took us to is called cyrusozfund.com. This is the fund that he has founded alongside Rick Fujimoto. So this is about them, a little bit about them and their background. And in this site, you'll notice that there's tabs up here that will talk to you about how the Opportunities Fund works. and the tax advantages and some of there. I think he's back in.
Okay, thanks, Suhei. So here's what we're gonna do. In fact, we're gonna start right here on this page. Okay.
Well, I could go back home. That's fine.
Yeah, so go ahead and scroll down. There's a map that I want everyone to see how it works. Okay, right here. So what are qualified opportunity zones? So guys, as you can see, the first thing that I want you to each be aware of is that it's really simple to find out where the qualified opportunity zones are. And there's a map that we've just imported into our website, but you can pick any area and see whether it exists. So anytime I'm looking at a property for us to potentially purchase for our fund, the very first thing that I'm going to do is pull up the map and see if it falls inside of an opportunity zone fund or inside of an opportunity zone. Okay. And so there's the area that I'm in. I know that there's one in Upland, and I'm in Laverne in Ontario. There's a lot of the Inland Empire, but you can see that primarily this is going to be the areas that are maybe not as affluent. And so because of that, the state has designated these underserved areas as opportunity zones in order to be able to attract investment capital. Okay, so now let's jump up a little bit, Suhei, if you could, to just right above this. There's three key things that are federal tax incentives that I want to talk through. And guys, this is where the magic is. Okay, how it works. All right, and one of the things that I've noticed is if we can, as investors, or if we can, as professionals that are giving guidance to investors, bring a fresh idea and a fresh way of thinking, such as this, it will set us apart in a way that is very significant. Now, as far as what is allowed with an investor that is participating in a qualified opportunity zone fund, there's three key things. The first one that's very significant is what is going to be the deferring of any capital gains tax on the federal level. Okay, this is federal capital gains tax. And as an example, if someone has a property, and I'll just use a fairly recent case study. Had a client that sold a property that was a $1 million sales price. They had about 400,000 of gains. They had a basis of about 600,000. That $400,000, and that was an opportunity for 1031 exchange. The capital gains due on that 400,000 is significant. Okay, it's going to end up being potentially a six-figure number between federal and state. On the federal side, one of the benefits of the OZ is that if those gains are placed into a qualified opportunity zone fund within 180 days of receiving them. Now, not like a 1031 exchange, but in terms of receiving them. So this is something that can be a look back. The tax due on that is going to be deferred up until, and Suhei, correct me on the technicalities here, but through the end of 2026, which would mean due and payable April of 2027. Okay, so an individual that has capital gains today will not have to pay, in this case, that let's just call it $100,000 of tax, and that tax will not be due until April of 2027 if the gains portion is invested into a qualified opportunity zone fund. That's number one. Number two, in addition, there is a 10% step up in basis. Okay, so 10% step up in basis, and we're going to do an example in a minute that will show that we'll walk through and illustrate that. So that's 10% of what would have been due, or the gains will be eliminated because of the step up in basis. Okay, so let's just call it 400,000. All of a sudden now we've got only 360,000 of gains due instead of 400,000. And then finally, and guys, this is the part that is just amazing to me. Okay, the compounding of tax-free appreciation for a 10-year window, as long as that investment remains in a qualified opportunity zone fund for a 10-year window, it can then come out of the fund and back to you, very similar to the way a Roth IRA is treated, where you have the compounding growth of your investment, and then you have the receipt of all those gains without having capital gains tax due. Okay, I've never seen anything like this before. My years of both securities and real estate, to be able to see something that is this unique. Now, one of the things that's really unique here that I want to make sure we don't miss is that, and there is a Suhei, there is a page that shows splitting the basis. If we go to the frequently asked questions, let's see, go to about, and then go to FAQs, and then go to, let's see, yep, splitting basis and gains. Okay, so guys, think about this for investors that maybe are hesitant to sell a property. They don't want to 1031, or they don't have a good option for 1031, and they're hesitating to sell a property because they don't want to pay the tax. So now look at this. One of the things that this allows is for the splitting of the gains and the basis, because in this example I just gave you, where the previous individual had $1 million property, 400,000 of gains, and a $600,000 basis, this property was free and clear. Guess what they're able to do with that basis? They can take that $600,000, put it in their pocket, and it's theirs to work with. Reinvest it in any way that they see fit, while they're taking just the gains portion and pushing that into a qualified opportunity fund. Make sense? Okay, good. So the gain, this is really fascinating here, because this is something that allows for a lot of latitude for investors, because many of the investors, in fact, if you stop and think about a lot of the folks living in California, there's a lot of folks that may want to sell California real estate, but they're not, because they don't know that they have this option. They only think they have an option of doing a 1031 exchange or of paying the tax, right? So this is very, very unique in that way. So I bring this up, guys, because there is an opportunity here to be able to have a unique conversation in the marketplace with something that is a big part of that was part of the 2017 Tax Act that just about nobody knows about, right? And so I was thinking about this. Why does no one know about this? This is a big deal. I mean, you'd think about it. This is something that should be like headline news for investors of how significant that is. If they could sell California real estate and without having to go through a 1031. In fact, Suhei, we actually have a chart on here that shows a 1031 side by side with the OZ. If we go back to the FAQ, right, opportunity zone investing versus 1031 exchange, just below that. And it's the second one, the second page, there it is. Gotcha. So now, one of the things that I want to make us all aware of is that the gains don't have to be just real estate, okay? The gains can be cryptocurrency. They can be art. They can be securities. They can certainly be real estate. They can be any capital gains that you receive will be eligible for contribution into a qualified opportunity fund, which then needs to be invested into the opportunity zone themselves, compared to a 1031 exchange. Okay, makes sense? So now if you look at, it's the third section down on here, you can see with, actually, no, I'm sorry, Suhei, stay there. On this comparison right here, we have for any investor, in fact, if you were to take a look back and think of any of your investors that didn't do a 1031 exchange, but they sold investment property in the last 180 days, as opposed to having the tax triggered once it comes out of the 1031, they have 180 days to contribute from the capital gains into an OZ fund to still receive this treatment. Okay, so 180 days back from, that's the window of time, sort of the opposite of a 1031 exchange, where you've got 45 days to designate your replacement property and then 180 days to close on the exchange. If somebody that you know has sold a property and they've triggered capital gains tax due, they have 180 days from the time of receipt of that gain to be able to have this then invested into a qualified opportunity zone fund and still be eligible for the benefit that I talked about just prior, which is the deferring of the gains until April of 2027, the 10% step up in basis, and then as long as those funds remain invested in the OZ for a 10-year window, having those exit tax-free. Okay, so that's a lot to cover. Those are the three key things that I wanted to make you aware of and see how this compares to a 1031 exchange, because I want each of you guys to be able to have a unique conversation with your investor clients in a way that is not normal and not normal in the marketplace, not common. So I'm going to hit pause and see, hey, what I think might be good is I think it would be good if we were to do an example, and maybe why don't we talk through and have some of your expertise on the tax law and then look at a case study.
Awesome. Thank you, Mike. Hello, everyone. My name is Suhey Piedra, and I'm an enrolled agent. I'm a tax professional here in the city of Glendora. And when Mike came to me with this opportunity, I found it very unique, and a lot of people did not really know the tax advantages of it. But as we all know, with the real estate market being such a good opportunity for you to sell, but is it such a good opportunity to go and buy or to do a 1031 exchange? A lot of people get scared and feel like I'm going to run out of time to find that other property because of the way the market is so hot right now and everybody's buying and everything's flying out off the shelves. So we get a lot of hesitation. Or you have individuals that invested into virtual currency, and because of the way the market is, they just made these huge profits. So with the Opportunity Zone Fund, we were able to tell these clients, it's okay for you to sell and turn around and do, invest those dollars into the Opportunity Zone Fund and defer those taxes. So what I always like to show my clients is, well, the question that I always get from my clients is, but with taxes rising, is investing in a qualified opportunity zone fund still a good investment? So the current administration, we always hear where, there's things out there, bills that are trying to get passed where there is going to be a tax hike. So even though you can sell your property today, invest into a qualified opportunity zone fund, you can walk away with your basis. So that means you can walk away with some money. And remember, in a 1031 exchange is all or nothing. You have to pretty much invest, turn around and do a 1031 exchange of all of the proceeds. With the Opportunity Zone Fund, you can walk away with some of the money, go out and do something different, only invest the capital gains into the fund and defer the taxes on the capital gains. The taxes do have to be paid, like Mike said, the year of 2026 when you file your tax return for 2026. And those capital gains are going to be taxed with whatever the current tax is in that year. So people are saying, well, if taxes are going to be going up, is it still a good investment? So what we did is we went in and we started to look at what are the good opportunities of, still investing into the OZ, even though taxes may still be going up. So in short term, you have a temporary deferral of the capital gains. So no taxes get paid today, opportunity for you to make more money on your money today and then pay the taxes down the road. The other big thing that is going to expire pretty soon by December of this year, 2021, is going to be that you have a 10% reduction of that capital gain. So you want to make sure you take a look at that and take advantage of that. And then the future exclusion of the gain, the taxes on that gain. So with this example that we created here, we have a capital gain of, for example, $1 million. So in this portion of the example, you did not invest in a opportunity zone. You walked away with your capital gain of $1 million. That means that when you filed your tax return today, the current rate would have been 23.8%. So you would have walked away with $762,000. If you turn around and you invest that with a 10% return or so, after 10-year holding period, you would have 1.9 million or so in that investment. Since your original investment was a 762, that means you would have a capital gain of $1.2 million. Well, Uncle Sam's at the door waiting for you to pay them his next share. So now you would have to pay capital gain rate on this 1.2 million of $289,000. So in this scenario, you're paying 238 plus 289 in taxes to Uncle Sam. If the taxes do go up to the new proposed rate, which is about 43%, and I put it right here in little parentheses, that means that you would pay the 23% today. You would pay the higher tax in the future. So you're talking about paying about $700,000 and some odd thousand in taxes if this tax hike occurs. If you were to invest the same dollars in a qualified opportunity zone fund today, your same $1 million, that means that you would get the reduction. So then taxable gain would only be 900. You pay the tax of 214,000. In 10 years, that would be worth about 2.5 million. Your original investment was the 1 million. So you have an appreciation of 1.5 or so. But then there's no after tax. Remember, it grows tax free. So definitely a lot better of an opportunity there. Now, if there is a tax hike and we have to turn around and pay a higher tax at 43%, you would pay on that $1 million at 390,000. So your money would still grow, but then again, you don't have to pay that tax on the new appreciation of value. So overall, investing in the qualified opportunity zone would still give you an opportunity to make additional funds, even though the tax hike was passed and you would have to pay a higher tax on those dollars. So taking advantage of that 10% reduction, taking advantage of that 10-year period, the growth would definitely look better in a qualified opportunity zone fund than it would to take the money with, the money today anyways. So Mike, I don't know if you wanted to point out anything else. I have the actual Excel sheet with the breakdown, but I didn't know if you wanted me to change some numbers or do anything like that.
Is that something you can do a screen share so we can, maybe we can just walk through, because we're, is that possible to screen share and look at the current scenario?
To look at a different scenario, yes. Hold on, let me share that portion of the. Okay. And
guys, Sue put this together, a really cool spreadsheet to be able to see this. And Sue, I think what we can, in fact, let's just talk through this as you're getting it up. Because she brings up a really good point, guys, because one of the things in helping planning for yourself as an investor or giving some guidance to your clients as an investor is to think through what is the difference between taxes if they stay the same versus if they adjust in the future. Because when you pay the capital gains in 2027, it will be based on the tax laws at that time. So we need to look at both scenarios, okay? We don't know, but we want to plan forward. And Sue's point is that even if there is a significant tax hike, in fact, we might even be able, I'm thinking out loud on this. I won't put you on the spot for this, but I'm just thinking, we've got the spreadsheet is, I would like, as an investor, the way I would think is how high can the taxes go in the future for me to still not have me going backwards per se, right? So what's the edge of the cliff, so to speak? So I think just to start, Sue, why don't we not do a higher future, or let's see, we've got the non-OZ. Yeah, can you blow this up a little bit?
So with this Excel sheet, we should be able to change the capital gain. So in your scenario earlier, you said they would walk away with a $400,000 capital gain or so. And, it just depends on what the estimated funds. So you can say, oh, Cyrus, what was the rate of return for Cyrus last year?
It was 15.4, but I don't plan on that for investors. Like our target is 1% per month or 12%
So let's
annualized.
just do 12%. And then the current and then the future rate over here. So a million works just because the formula is not changing the original capital gains, but so it changes everything else. So it still would be a good opportunity to invest into the OZ fund versus taking the money now.
And guys, if this is something that would be one of the things that we'll do at the end is there's two things that might be of value. One would be more info specifically on just, we've got a slide presentation that covers all of this that can help you or help investors. And then the other thing we can do is this is something fairly recent that Suhai and I have been working on, is just it's fairly fresh investor conversations is a specific question, just if, you know, current administration and we have adjustment in taxes in the future. So for some perspective, I'm you know, a sizable investor in this fund that I've created. We've set it up to be investor friendly on purpose. And I want this to be something that is that is simple for investors to evaluate. So we don't have, again, we're not a huge Wall Street fund. We're a smaller group really of a lot of investors that are just kind of like me that have the same thing. And because I've got fund management experience and with Rick Fujimoto and with Suhei's guidance, we've got a very succinct business model that we know works to do two things well. One, maximize the opportunity zone tax efficiencies that exist. And then two, we can talk about the investments separately. That's something that is part of this conversation. But really what we wanted you to understand today is conceptually what is possible. Okay, conceptually what is possible that was not on your radar before that can and should be on your radar right now for both yourself and for investor conversations. Okay, so and there was a question that I did want to address, and it had to do with the 1031 exchange and accommodator. And right, you do not need to have an accommodator for being able to participate in the opportunity zone fund. Okay, you can have if you sold, I mean, in fact, it's just the opposite. Once you take possession, in fact, and let me even take a step back. This is an ideal solution for somebody that intended to do a 1031 exchange, but had their exchange blown for whatever reason. I've had an exchange blown in the past. They send me a check, I pay the tax. Okay, not anymore. Now, if there's not an ideal 1031 option, guess what? Send me a check. I will then take all the gains. I want to take my basis back and I want to reinvest it again. And I'm going to take the gains and I'm going to put that into the qualified opportunity zone fund. And now those are going to be deferred until 2027. And whether it's, you know, 20% or 43%, I know for me, the math is going to be better than paying the tax today. Not to mention the benefit of the tax-free compounding of the full amount of the gains, and then the tax-free exit, very similar to a Roth IRA. Okay, so this is something that in my mind is the best of all worlds. Why? Because I get to take my basis back. There's something as an investor that's empowering about investing money, getting a return, taking the return that I've earned and pushing that into another growth opportunity that's very tax advantaged, and taking my basis back and getting to do it again and getting to do it again and getting to do it again. Okay, so
Mike, there's another question that somebody asked, if the 10% off, is it just for the investor or can it also be the residential? So if you want to answer that question.
Just make sure I understand. Right, so that is going to be the 10% step up in basis. Okay, so gotcha. So
so it doesn't have to be resident, it could be anything. It doesn't have to be a residential or commercial property. It's on the gain itself. Whatever your gain is, it's going to get a 10% knock off the step up in basis. So whatever that capital gain is, we calculate the 10%. And that's what, as long as it's invested before 12/31 of this year.
Got it. Yep. Jim, great question. How does the opportunity zone benefit from all this money that's flowing in? Well, if there's capital that needs to move into an area, it is going to inevitably have an attraction of, I mean, you think about it, if you look at a couple of different areas and all of a sudden you fast forward over, 5 to 10 years, and there's all these additional highest and best structures in real estate put in place, you inevitably start to change the climate of the area. So, and I don't know, it's a good question. I don't know what the percentage is, how much more money would be coming in based on the OZ. I'm sure it's going to be different for different areas, but I know for us, we are looking to buy specifically in areas that maybe we didn't want to buy in before, right? And so all of a sudden now, you've got a concentration of highest and best that just did not exist there before. You start to
And
move.
also, I would think, right, these are distressed areas. So you're coming in, improving them, right? And it could be commercial property and it could be residential property. So a lot of maybe more retail, maybe bringing in newer commercial stuff that has a mixed use, residential and commercial. So it's improving the overall area. The opportunity zone was zoned for a reason, right? Is it lower income, maybe something like that? Is that what those areas are typically, Mike?
Yeah, in theory, it was the bottom 25% of income areas for a respective state. And they don't have to follow that. That was the federal guidance, but each state has the flexibility that they needed to cover a certain percentage in that area. But bottom 25% of in terms of wealth, and so a lot of potential poverty areas. And yes, to answer the other question that popped up, you can sell first, close, receive your funds, and then as long as within 180 days from the time you took possession, escrow closed, and you received your money, that then you have a 180-day window moving forward to invest that into a qualified opportunity zone fund. Great question. Yep, great question. So good. So yeah, thanks, Suhei, for walking through that. There's guys, as you know, there is a lot of different scenarios that come up, but I know, in fact, I'm going to brag about Suhei for a minute. One of the reasons that I was with a prior tax professional for about 15 years, and I moved all of my business over to Suhei because she brought fresh ideas and fresh thinking to me. Okay, she opened up a world of ideas and possibility that I didn't think about before. And there was such value there, and it was very material. And so I bring this up, guys, because I always think there's two separate things that we want to be available of, that we want to consider. Let's call it the steak and the sizzle, right? They're very different. Okay, so you can have how much more likely would it be for you to secure a listing if it's a competitive situation, if you bring up these types of ideas to the potential seller that your competition is not? Now, whether this makes sense to do or not is a separate conversation. So what I want to do here is maximize the opportunity. Very few people are talking about this. Very few. Okay. Very few. And it blows my mind. And I want to unpack why, because I think it's very important, right? Some people think, it's too good to be true. It must not be true. Not the case. We spent a year and a half researching this before we got up and running. Okay. What's the scenario here? So here's why. When I worked as a financial advisor, we had to be under the jurisdiction of a broker-dealer. A broker-dealer has parameters over what investments they will allow and not allow. Okay, so financial advisors, the majority, there's also independent registered investment advisors, but it's a much smaller subsection of the advisor community. But as a financial advisor, I was Series 7, 66, and LUTCF. So as a financial advisor, I only had certain things I was allowed to do and talk about. So my point being, this is off the radar of just about every single financial advisor. And because it's rare and fairly new, it's off the radar of almost all tax professionals as well. They've heard of it, but it's just like anything. If it's not in your habit stream, we're all creatures of habit. If it's not in your habit stream, it's sort of like background noise. And it's a lot of heavy lifting for them to be able to go through and do all of the research to get up to speed on whether it's something, there's more liability for them. So one of the things, again, one of the reasons that I really appreciate Suhei is she did all the research on this. She spent hours and hours researching all the tax law. And there's a few experts nationwide, and had conference calls with them in order for us to be able to validate, to make sure that we are staying in the lines and maximizing something that is available. So that's one of the reasons, is that it's just not on the radar for advisors, for CPAs, or for real estate professionals. So this gives us the ability to bring fresh thinking to our clients in a way that our competition is not. Okay, couple more questions here in the chat. New rental rates, gotcha. So no, good question, Jim. So no, this is not something where it needs to fit into a quote affordable housing box. That's not the point of this. There are cities that will have, special guidance on, different areas that are designated for that. That's not what this is. This is set up specifically to attract money on a broad scale into whatever it is, the 15 or 20% area that you could see in the map before. We don't have to have a particular sales price or a particular affordability, or that's a different program. That's a different line of thinking. So I'm somewhat familiar with that, but that's not related to the OZ at all.
And I just want to add on that, what the client gets. I'm sorry, Mike. It was the next question.
Oh yeah, no, go ahead. Go ahead with that one.
The next question is the qualified opportunity zone fund like a REIT, or can it invest in anything in the OZ zone area? And I was just going to say with that, obviously it gets a K1 that it's set up as a, Mike and his partner have this set up. So it's a partnership. I mean, it's an entity where they control where the funds are invested. Is that right, Mike? How that works?
Correct. We evaluate the opportunities and do that systematically. And the majority of what we're doing is currently in California, buying land in certain areas and building out 100 units over the next couple of years for cash flow apartments. In addition to that, just as far as our investment strategy, just being in this space for a long time, there's a lot of realtor connections I have that will bring me cash purchase opportunities, just because we've been a cash buyer for a long time. So we have a good amount of off-market looks at things before it ever hits the MLS. It's distressed, but we've got the systems and the capacity to be able to go through and maximize highest and best for a property. So those are some of the things that we're doing. Now, as far as the Qualified Opportunity Zone Fund, we have to keep 70% of all of our activity in the OZ. So that's one of the advantages, is we may come across a really good opportunity, but it's not in the OZ. Our fund is still allowed to buy it as long as we don't overstep that 70-30 parameter that's put in place for us in terms of managing a QOF. Okay. So, and in addition, guess what? We can buy and sell as to maximize whatever the opportunity is inside of the fund without triggering a tax consequence for any of our capital gains investors, right? So that's the benefit of the Qualified Opportunity Fund, is we can buy and sell as we see fit. We don't have to slow play something like individual investors do, because you're going to have a huge tax consequence. So good question, but I did want to make that known. As long as we have 70% inside of the OZ, 30% can be outside. Jim, good question. Minimum buy-in. Okay, so there's some parameters on this. We have to have the investor needs to be an accredited investor. okay, accredited investor. And just to walk through what that means, and it's 100,000 is the minimum contribution to be able to participate. So 100,000 minimum, accredited investor, and an accredited investor is someone that has, there's a couple of guidelines to this: $1 million net worth above and beyond a primary residence, or income of 200,000 as an individual, or income of 300,000 as a couple. That's the accredited investor guidelines. You get easy to Google, you could see what it is real quick. But as long as it's an accredited investor and 100,000 minimum, those are the parameters to be able to participate in the fund. So good questions, guys. Thank you, Jim. I appreciate it. Yeah, this is something, guys. This is not one of the things that was important to me. Is I had to solve my own pain, and I knew that there's so many others that have the same pain out there. And so a lot of this is thinking, if I have this issue, everyone else there's going to be a lot of people that have this issue. Blown 1031 exchanges. Okay. I don't want to sell because I have a taxable consequence. Now I'm excited because I can find an opportunity, buy it, sell it. And I actually do this way more than the 1031 now, as Suhei will tell you, because she manages everything for me, her and her team. If I come across an opportunity, I'm going to buy it. I'm going to harvest the capital gains. I'm going to take possession of them. I'm going to push them into the Qualified Opportunity Zone Fund, and I'm going to have them grow for 10 years tax-free. And our goal is real simple. Like, I'm a simple guy. Here's the math on this. If investment returns are 7.2%, money's going to double over 10 years. If investment returns are 11.6%, money's going to triple over 10 years. If investment returns are, I think it's 15%, it's going to quadruple. Okay, that's the math. My goal is simple. We don't speculate. We don't gamble. We buy in at value. I'd rather have cash sitting there than take risk. Okay, so fortunately, we've been able to find good opportunities, even in this really tight market. So we're very well positioned as the market adjusts to be able to move on things. Our target is really simple: 12%, 1% per month. I want money to triple over a 10-year window and have it exit tax-free. That's very simple. It's very straightforward. And that's what my current plan is. And that's the plan that, a handful of the other investors that are in similar situations. So, to become an investor, we have a PPM that we can send out. In fact, I'll type my best email in the chat. If you want to receive a prospectus as a potential investor, or even if you just want to read through it, because you may have clients that you think this could be, all the things that we've covered today, you can actually see about, I don't know, maybe a third of it or half of it on the website at the cyrusozfund.com. If you want a good illustration of 1031 versus OZ, and then also a couple of different case studies. But yeah, guys, we're anything that we can do to be able to potentially make a difference in the lives of our investors and our clients that sets us apart. These are the things that I think can be very valuable. So let me type my email for you real quick.
Mike, this is Mr. Lee. Can I ask a couple of questions?
Yes, please.
Thanks for doing a very educational seminar for all of us. On this OC fund, how do you guys charge for your service? You probably have to make some fees along the process by putting all this stuff together. So is that front end low at the end, or is there an annual service charge?
Great question. Nope, absolutely. Since we're an actively managed fund, and this is traditional for in the fund space, is we have an 80-20 share. So investors get 80% of all of the returns. We have 20%. So the managing partner. So that if you know anything about the fund world, where it's meant to be very investor friendly, and I'm an investor, obviously, in the fund and a large investor. So 20% will go to the managing partners. 80% of the returns will go to whoever the investor is. So, right. So that puts us all on the same side of the table, and I want it that way. I want it on the same side of the table.
No, I definitely agree, because if you make money, we all make money, and you don't want an investor to lose money in the process. So it's a win-win situation.
Right.
The other question is, I assume you probably have different types of funds for the OC opportunities, Fund A, Fund B, Fund C. Are there limitations to how many partners can get in, or some funds are closed to outside investors to wait for that 10 years period? Do you have a waiting period that a certain fund might open, or you're looking at new funds now? We have DEF open to new investors because ABC are closed. Or can I resell the fund within A, B, or C after I held it for, let's say, 5 years? I want to get out.
We don't have an A, B, or C. We have two different classes of shares. One is for a conservative investor. The other one is for pretty much every other investor that just wants to maximize their wealth. So we have a 6% priority return. If somebody wants to just have a guaranteed income, they have a 6% option, or they opt for the 80-20. Okay. So now we don't have different fund shares, but we will reevaluate, and we will accept new funds twice a year. Okay. So every July and every January, we're open for new investment. Those are the windows, because we're doing a reevaluation at that point for the fund. So if there is investors, and that also, one of the things that Suhei helped us with, that allows us to be able to have a window for anybody for the 180-day look back. So where every 180 days we open, every 180 days we have to do reporting. And so that's the window, and super strict. January 1st to January 31st will be the next window. And we don't have, part of what we do also is we're managing opportunity and funds. So we will at some point cut off. I don't know what that number is for January, but we will have a cutoff based on, because and this is a lesson I learned the hard way in the past, back during the Great Recession with the other fund, is we had too much cash sitting on the sidelines, and we couldn't deploy it into investments that we felt comfortable with. So it diluted the returns. So again, it's not that we were taking risk, we weren't, but one of the things, as you guys all know that have been in the business a while, is we bought a lot of properties at auction. And after a while, there's some hedge funds, Blackstone and others, that started coming in and buying at price points that were just, in my opinion, didn't make any sense. We would typically buy at 70 cents on the dollar or below. They would started to buy, 90, 95. They had to deploy funds because they just had idle cash sitting. So it was a deployment challenge and play for them. And that caused a lot of people to say, I'm not willing to buy at that price. So we had a really, really good run for a number of years with our previous fund. Everyone did really well. First year was phenomenal. Second year was really good. Third year was okay, but we were barely meeting the hurdle rate at the time. And so we said to all the investors, it's been a great run. This wasn't an OZ fund, it was a different fund, but it's very important to me to be able to protect investors. Like, I take it very, very seriously. And so we made the decision to send everyone their money back. Since it was getting too difficult. So in this case, it's different because investors have to go somewhere. Like, otherwise you're losing 30% or whatever the number is based on your tax bracket right off the top, right? And so but for me, again, because I'm created this, but I'm also an investor, I don't want to compromise on either. I don't want to pay the tax, and I don't want to compromise on sound investments. So this is set up to make sure that we are respectful of both.
Okay. I want to ask a question for Jack, and he's trying to time the market. Last year, the stock market has been accelerated quite rapidly. And his question was, if I sell the stocks, short-term and long-term capital gain, and he wanted to time it so he can get it into your OC fund. Is that even possible based on that you have only 2 openings within a fiscal year?
Got it. Great question. Great question. So it is, and again, we're set up specifically with those two different entry points. So if somebody needs to sell, let's say someone sells on, July or July, August 1st, then they can enter in January because it's a 180-day window from the time of sale. So no individual is going to end up getting caught missing a window if they sell anytime, right? As long as you've got that 180 days look back. So we've had investors that have been on either extreme. Someone, they just sold it. We had one gentleman, because he didn't want to miss the window. So if I'm remembering correctly too, hey, I can't remember the timing, but it was I think he sold something, and it was, I don't know if it was right in July, and it was like a day, we were just about to close. And so he wired in funds, like was comfortable with it, did all his research and wired in funds right at the end of July to not miss his window. So, but that's it's intentionally set up that way. We have to do our reevaluation windows. And then investors, they've got their 180-day cushion based on whenever they do sell something.
Short interruption, Mike. How about the tax reporting? April 15, would that put a constraint on when we can get into your program, or if we can get into your program, do we have to report tax for the capital gains for prior fiscal year?
Suhei, why don't you take that one?
So the taxes are triggered when you make the sale.
Right.
So it's going to be short-term or long-term capital gains. And say you sell today, 2021. So when at time of tax filing, you're still going to report the sale of your stock. But then there's a form that you file that says, I put the capital gains into an opportunity zone fund. We give you the ID number, you get all the information on what fund you deposit the funds. And then on the federal side, that tax gets deferred. In other words, you won't have the tax due for that particular year because it's you put the money into the opportunity zone fund, even if it goes in January.
Suhei, I agree with you, but I'm not too sure most of our CPA know that form.
No, and that's correct. And so it's luckily right now what we've been doing is we provide the form number. It's not a big deal. There's not a lot of opportunity zone fund. There's one to report the sale of the fund, and there's one to report the entry into the fund. So it's not extremely complicated. When you're part of the fund, you get a K-1 to report any capital gains that's been going on into the fund. And again, you just let the tax return, the preparer know that you've reinvested it into the fund, and it's the same thing. So it's not something that requires a whole bunch of reporting. It's just report where the money went, the fund number, and then you're good to go.
Okay, thank you. Another question for Mike. We are investing in the OC zone because the government or federal agencies somehow designate that area need outside capital injections. So for most of us who wants to do it on our own, we probably don't have the resources or knowledge to go and do that type of research. So that's why you are doing all this work for us. Am I right? Let's say if I don't want to invest in a fund, I want to invest in an area, let's say buy an apartment, creating an industrial complex, hire factory workers. Those are possibilities, but it's not in a fund basis. It's more of a OC investment. Is that true?
Right. So you can have a qualified opportunity zone fund or a qualified opportunity zone business. Okay. And there is, and I'm not an expert on this at all. We did look at this early on, but you're right. You have to either launch your own or be a part of one. And it's not simple, but it's not, I mean, if there's investors that have, I don't know what the number would be, sophisticated, I did talk to an investor that was he had 2 sales, capital gains of about 5 million for each. So he had about $10 million. And I was talking with him, and it made more sense. He had very sophisticated tax counsel. He was and a tax law attorney. He was going to create an opportunity zone business, right? So that was better for him. So there are some places where this wouldn't be a fit, but What I know is there's a lot of folks that they're never going to do that on their own. And they're sort of in this space where it is just a really good option. Yeah, if you can put it together on your own as a qualified opportunity zone business or your own qualified opportunity zone fund and handle all the reporting, there's a good amount of reporting involved in management. It took us about a year of lining this up to get it launched. I think we could probably do it in 6 months now that we've figured some things out. But yeah, it is certainly a possibility for anyone that wants to do it on their own. It's interesting. There's not a lot of, it's almost like there's the tax law, and this is something that Sue and I and Rick, and we've got some more counsel that we've talked through. There's some things that they're just not clear on. It's just really vague. So we just need to make sure that wherever that guidance is, that we stay and we err on the side of caution with how we do things, because we want to make certain that we don't step over a line that causes the entire fund to be null and void. So we're very careful about that. So, but again, anyone that is a sizable investor and has the right counsel, they could certainly do this on their own.
I totally agree. It just a thought that for somebody who is a multi-millionaire, he wants to do this on his own. Yep. And for us, try to qualify to be an accredited investor is not easy enough already. $200,000 income, over $1 million net worth, and all these things, and probably have some sophisticated investing experience. For us to be accepted into your program is a challenge in itself already. I don't have anything to add. I was wondering, just sending the open floor to all the people who participated in this very educational workshop. Do you have any questions that you want to ask Mike or Suhei? Feel free to type in. I'll give you 30 seconds. If that's not, then I'll pass the floor back to Pauline. So we'll give you 10 or 15 seconds to say, I have a question, ...
And guys, if you have, my email's in the chat. If you want, all you have to write in the subject line is more info if you'd like us to send you the information packet. So just feel welcome, hit my email, more info in the subject line, and we'll reply with with an information packet that could be helpful. We'll give you everything we've done. There's not it's maybe 30 pages or so, and it has some of the different illustrations and charts.
And Suhei, if I can ask you a question, that Excel spreadsheet that you illustrated as a comparison, I think it will be helpful for most of us real estate salesperson to show it to a potential investors, at least give him or her some options as far as where to park the money after whatever that they want to sell and try to avoid the capital gain tax. If you can send it to Pauline, and then whoever wants it, I will deal with the distribution among ourselves. Thank you, Suhei.
You're very welcome.
Mike.
Yes.
I don't have anything. Pauline?
Okay, Janet, I don't understand. You say, can you put an OZ listing here? Janet Chan. Janet say, I have a listing in OZ zoning. It's interesting. Mike, do you want to know that?
Got it. So one of the parameters that we have for the OZ fund is that we have to, and this is part of the reason that it's a benefit to the area, is that we have to have a substantial improvement opportunity in order to purchase that property. So specifically, what you back out the land value, whatever the structural value is, we have to add that same amount in improvements. So oversimplified, if land is 100,000, structure is 100,000, we would need to invest 100,000 minimum. So if there's anything that you guys come across that you think would be, a lot of, obviously all these are cash purchases, some are distressed, whatever the case may be. If there is a scenario where it's going to be substantial improvements and it is in the OZ, yes, I would like to look at that. Great question.
Perfect, Mr. Lee. So we don't have any more questions, right?
I don't see any.
Okay, great. At this time, I really appreciate and I want to thank Mike Hardy, Saros OZ Fund, and Suhei Piedra, Prominence Business and Wealth Management, for your informative information and great presentation today. We learned a smart way for 1031 exchange purpose, a more efficient way, and save our more tax. in our investment. Thank you so much. Okay. And a quick reminder for next week, we have a whole week, 4 days live CCIM CI 101 class. If you feel interesting to attend it, please just check with wsgvar.com, click education schedule to enroll. And September 27, Monday, 11 o'clock, we have a commercial and residential real estate outlook class again. So we thank you so much for today, Mike, Suhei, and Fang, and Mr. Lee, and Jenny, and all of you. We all learn together, and this is a great and wonderful section. Thank you so much again. And we want to see you the end of September and next week live in St. Gabriel Board, commercial CI 101. Thank you.
Thank you. Bye-bye.
Bye-bye.